Hey everyone, today I'm going to show you exactly how the long-term forecast works. The same indicator I rely on every day for my portfolio management. We'll start simple, then dive deeper. By the end, you'll understand not just what the WitFin indicator is, but why exactly it works. And don't worry, I'll put timestamps in the description so you can jump to any section you like. Let's start with the basics. When you invest, you're faced with a choice. Play it safe in treasury bonds and earn a guaranteed rate of return, or invest in stocks, and earn potentially much more. Let's see how this plays out in practice with an example. Let's compare two investors, Risky Rex and Timid Timothy. Rex and Timothy both started with $1,000 in 1962. Risky Rex bought an S&P 500 ETF. That's an exchange-traded fund, which is just a basket of stocks you can buy with a single click. And he reinvested all of his dividends. Timid Timothy, on the other hand, played it safe and just bought a treasury bond ETF, also reinvesting all of his dividends. As you can see from the chart, Risky Rex dramatically outperformed Timid Timothy over the long-term period. This outperformance is the reward investors like Rex get for taking on long-term risk. But here's the key insight. This outperformance is not random. It follows predictable cycles we can measure and use to our advantage. If you're still with me, great. Let's move on to the intermediate explanation. To measure these cycles, we can't just compare the raw returns directly. The performance ratio between stocks to bonds grows exponentially over time. To make this easier to analyze, we first take the natural log of this ratio. This is a standard technique that transforms an exponential growth curve from compounding growth into something that behaves more like a straight line. With that done, we can then perform a linear regression to find the true long-term growth trend of stocks relative to bonds. Think of it this way. We're measuring how far stocks have strayed from the long-term path, whether they've run too hot or fallen too far behind. This difference between the actual performance and the expected path gives us what we call a residual value. These residuals are then what we can then turn into percentiles that you see on the WitFin website, showing us whether the market is over or undervalued relative to its long-term historical growth trend. Okay, so let's recap. We're measuring how far stock performance has deviated from its long-term trend against bonds. If you're a data nerd like me, you might have recognized that the residuals we calculated aren't exactly normally distributed. They're skewed. So we apply something that's called a Yeo-Johnson transformation to normalize them. And voila! This mathematical adjustment reveals that market cycles aren't chaos, they actually follow a natural, relatively predictable pattern. Here's what this means. Market cycles of fear and greed aren't just random emotions. They're mathematical patterns that we can quantify with the WitFin indicator. From the generational buying opportunity presented in March of 2009 to the extreme valuations presented in .com and today, this indicator helps us cut through the noise in markets. You can try recreating this yourself, or you can visit www.witfin.com/expected market moves to see this live indicator for free. Thank you for watching, and we look forward to seeing you in the next video where we will cover the short-term markets forecasts. Thank you.